Hello, ladies and gentlemen, this is Joe Hacker. You ask yourself how mergers and acquisitions, initial public offering, and private equity, how they all connected? Well, here are 10 steps on how they are connected. We base our analysis on this book, Applied International Corporate Finance by Dietmar Ernst and myself. The answers to the 10 questions are in the book. So let's get started. Question number 1, how are mergers and acquisitions, private equity, initial public offering connected based on a corporate finance perspective? Well, if we analyze the life cycle of a company, we come up with 4 phases, the so-called introduction, growth, maturity, and the decline. If we ask ourselves, how can the financing be done in the respective different phases? We come up with phase 4, the decline, and in this phase, going private will be done, i.e. will carry out a delisting. In the phase maturity, the preferable corporate finance transaction will be mergers and acquisitions. A trade sale can be done, a company can be acquired, or our company can be merged with another entity. In phase 2, in the growth phase, an initial public offering, an IPO, can be done, or a trade sale or an acquisition. The preferred transaction based on a corporate finance perspective will of course be the IPO. Phase 1 comes with venture capital. A so-called early stage financing is being carried out. At the beginning, we'll find the so-called seed financing, then later on the so-called start-up financing, and then the first stage financing. Then after early stage financing, we can carry out a so-called later stage financing. And this can all be done by private equity companies. So we see here, venture capitalists are a part of private equity firms. Financial investors are important in the initial public offering, in the mergers and acquisitions, as well as in the going private phase. In this phase, very often a private equity actually takes private the company. Here, the seller or the buyer can be a private equity company. And here, when it comes to an IPO, it could be a preferred exit carried out by a private equity company. Question number 2, what valuation methods are dominant? If we start with phase 4, we see in the going private phase, the so-called book value / the net asset value is the dominant one. How can I calculate the book value? Well, basically, you take the equity position of the fully consolidated balance sheet and subtract the minorities. This results in the book value. In the M&A phase, we come up with a so-called discounted cash flow method. Second, if the company is listed, the market cap, i.e. the shares out times share price, is relevant. Furthermore, the transaction multiples are important, of course, the book value as well, and the so-called trading multiples. When we talk about an IPO, the DCF is also very important. Furthermore, the trading multiples, that among these are especially enterprise value sales, enterprise value EBITDA, and enterprise value EBIT. In the phase number 1, venture capital, out of the multiples, the transaction multiple, especially the EV sales multiple, is important. Furthermore, you can use other underlyings such as the clicks, the so-called churn rate, like how many people click on my webpage, and how many people actually are paying for my products. This is pointed out by the churn rate. Furthermore, the customer acquisition cost and the long-term value. And the ratio here tells me clearly what part of the phase one I'm in. There are other more specific, more detailed valuation methods, like a venture capital model. I pointed out one in the book called Telemedicine on page 176 to 185. So we could conclude here, especially the sales multiple and the venture capital model is really important. Here, the major valuation methods are trading multiples plus DCF. Here, DCF plus transaction multiples. And here, the core valuation method is the book value. If you come up with an example, like we are a farmer and we want to carry out the valuation of a cow, the meat of the cow would be the book value. So if we slaughter the cow, we can actually eat the meat. If you slaughter the cow, you cannot drink the milk. Speaking of which, the milk is basically the so-called free cash flow, which is being discounted in the discounted cash flow method. And the market value of equity is the result. And that can be then compared to the book value. If this DCF value exceeds the book value, thumbs up, we are on the right track. If the DCF value is below the book value, then we are basically in trouble. And we see in phase 4, we see very often companies with a lower price book multiple, i.e. with the market cap below book value. Step number 3, what valuation methods are applied in the M&A and in the IPO case? So we scrutinize this one here in further details. You can see in the M&A case, if a company is listed, the market cap is taken. If the company is not listed, very often the transaction multiples are very, very important, because in M&A, A buys B, so a transaction is really core. And we use basically the following 5 multiples: EV/EBITDA, EV/EBIT, EV sales, price book, price earnings. Here, there's a sort of ranking. So we usually consider the EV/EBITDA multiple to be more important than just an EV sales or a PE multiple, because if you take a profit and loss account, sales is on top, earnings are bottom line. So you want to look for something that is sort of in between top and bottom. And this is hardly to influence. And it's a very stable value. So a rational investor would rather go for an EV/EBITDA multiple compared to those multiples. So the ones in blue are not relevant in the IPO case because the company is not listed. So therefore we cannot use the market cap, and the transaction multiples cannot be applied because here the underlying assumption is it's about 100% of a company. Here, you might come up with 50, 51% of a company. Your transaction includes different shares, different amount of shares that will be bought. However, the DCF is really core in the M&A case and in the IPO case. The book value is the floor. So in an IPO case, it is rather not the core element, because as we saw here, the book value, we expect a price book to be significantly above 1 because we have a growth perspective in this phase. However, here might be some decline, and if we are in the end of the phase 3, beginning phase 4, the book value is really important. Therefore, the book value is more important in the M&A case compared to the IPO case. Furthermore, we see the trading multiples to be also important in the M&A case. However, in the IPO case, they are much more important because the basis of the trading multiples is a so-called peer group. We ask ourselves, how are we valued compared to our other companies, to our competitors, to our peer group? And in the IPO case, the listed peer group, the companies, they are really core when we derive the book building range. So the book building range can be determined by having a look, how are the other companies doing, how are they considered to be the rising star, or do they hitting rock bottom? Hopefully they are the rising star, and in this case they will help me to move the book building range towards the right. So actually our evaluation of the valuation depends significantly on the respective industry, on the specific life cycle of the company, etc. However, generally speaking, the above mentioned holds true. Question number 4, how can the valuation range be determined? Well, we'll have a look at the so-called football field. The pharma group is pointed out in the football field. We derived results for pharma group, and you see here we came up with 3 market value of equities that are based on transaction multiples. We came up with 5 market values of equity that are based on the trading multiples. We pointed out the market cap and the book value. And last but not least, 3 different approaches have been carried out, the so-called WACC approach, APV approach, and the equity approach. In those 2 cases, we didn't come up with a constant weighted average cost of capital. However, so-called periodic specific WACC has been applied. The periodic WACC approach, the APV approach, and the periodic equity approach comes up to the very same result. There is not 1 cent of difference within these 3 approaches if applied correctly, which we have done here. So in our case, we come up with 85 billion rough based on DCF. Next one, the market cap is slightly smaller. You see a price book multiple of 4 roughly. You see the trading multiples are lower than the DCF and the market cap. However, the enterprise value sale-based trading multiple result is higher, and you see the transaction multiples are higher than the DCF. Starting with the transaction multiple. That is a typical result because here we're having a price and this is a value. Value plus premium is price. So therefore, we see usually the transaction multiples coming up with a higher result. Tick the box. Next one, DCF and market cap are pretty much the same. So this is a very, very, very strong value. This actually points us out the direction of the valuation. This is the floor of the valuation. So basically for our interpretation, this is not actually the relevant value. Furthermore, we see some EV sales multiple based result to be exceeding all the other results. The conclusion is we see some other margins. Our peer group is not really directly comparable to my underlying pharma group. We see in this case, we, i.e. pharma group, is doing better than the peer group. However, in terms of sales, there's a significant difference. And we actually having a huge sales multiple due to the lower profitability of our peer group, although the profitability is quite nice. However, compared to us, they are less profitable. So the EV sales multiple being higher. And if we multiply that high EV sales multiple with our underlying, we come up with an extraordinary high result. So therefore, we basically don't take this one and that one into consideration. What we should do, we should go back to our peer group analyze and scrutinize this in further detail, and maybe made some adaptations and maybe change a bit the consistency of the peer group. We might put one company in or out. We might discuss about the underlying data, and then we might end up actually with another peer group. However, if we don't go the extra mile in this case, we conclude that the valuation range is roughly here between 84 and 87 billion euros. This is the value of Pharma Group for 100% of Pharma Group. That's the conclusion of our football field regarding question number 4. And we spoke about the difference between value and price. And this can be seen here in question number 5. What role does a takeover premium play? We see the fair standalone value plus the premium, here the takeover premium, equals the transaction price that is being paid. Value plus premium is price. What is the difference between value and price? Well, how can I actually define the takeover premium? How can I derive the takeover premium? Well, it depends on basically 5 different issues. The form of payment. If the payment is in cash, we rather come up with a lower price that needs to be paid, because in finance we say cash is king, and that's it. On the other side, if you receive shares as a seller, this usually comes up with a lockup period of, let's say, 2 years, and you're locked up. Therefore, you want a higher premium. And assume you're even being paid partially or fully in option, then you want a much higher takeover premium. Synergy potential. If you have a low synergy potential, then usually the takeover premium is rather low. If there's a high synergy potential, you end up with a higher transaction price paid. Usually the synergy potential is bigger with a so-called strategic investor compared to a financial investor. So if we go back to our private equity investor, well, in an M&A transaction, they tend actually to have the problem of rather lower synergy potential that can be realized, contrary to the strategic investor. Number 3, buyer competition. If you come up with an exclusive buyer competition, well, then usually you come up with lower transaction price. Assume a full public auction where it's all known to everybody out there that the company is for sale. This implies a higher transaction price to be paid. Number 4, the stake. If you buy a minority stake, the takeover premium will be lower compared to if you exceed the 50% threshold and you come up with a majority stake. If you exceed the threshold 25, 30%, 50%, 75%, and 95%, then there always might be a tendency towards a higher premium. The thresholds I mentioned are important thresholds, like 30%, when do I need to come up with public offer to everybody? 50%, you're basically in the driver's seat. 75, nobody has a blocking minority, which you have when you got 25%. You basically can do everything, including M&A, including capital increase, actually. And 95, you need 95 for a so-called squeeze out. So depending on the stake, you pay lower or higher takeover premium. And last but not least, the kind of transaction. In a friendly takeover, the takeover premium tends to be lower. A hostile takeover usually comes with a relatively high premium because you're directly contacting the shareholders, not the management. And how can the shareholders be convinced that you are the one that should buy that company and you are not a black knight but a white knight? Well, by offering a nice takeover premium. Question number 6, the M&A process. How does the valuation change? You see here, initial phase, contacting phase, analysis phase, final phase. The M&A process comes in 4 phases. In all of the 4 phases, a valuation is being carried out. Like in a pitch, you use public available information and apply that public available information. And this results in a valuation. In the contacting phase, you are given, as a buyer, a so-called information memorandum. Based on the information memorandum, you carry out a valuation, and the result of the valuation will actually then be in the letter of intent. The seller then decides who gets access to the data room. In due diligence, you're scrutinizing the company in further detail, and you try to quantify the risk factors and the risky issues, and they all will be implemented in your spreadsheet, and your valuation done in analysis phase, in phase 3, will be much more profound compared to the one when you submitted a letter of intent, and especially in phase 1 when you actually focused on public information. Here you got public information in the information memorandum. A lot of information is given by the management that among these are, for example, the projected profit and loss account and balance sheet for the next 5 years, the cash flow statement, which enables you to derive the free cash flows, and so on and so on. So the more you go down that road, the more information you get. Therefore, in the binding offer, you based your result on a much better and more profound databases. And yeah, what we sort of can find in most of the cases, the purchase price you put in the letter of intent usually tends to exceed the purchase price you put in the binding offer, because you finding issues in due diligence, it usually reduces your purchase price, and then you put that in a binding offer, which, if the seller chooses you, will go into the purchase agreement, and in the purchase agreement there will be the final figures you will pay. And then it comes to a so-called signing. Between signing and closing, is antitrust authorities need to approve the transaction, and 75% plus 1 share needs to agree and be in favor of the transaction. So we see the valuation process changes significantly during the entire M&A case, depending on the information level you use as a basis for the valuation. In the M&A process, what sale process should be chosen by the seller? Well, we spoke about that here. What is my buyer competition? Is it rather exclusive, or is it an auction? And here you see, in a very exclusive way, it will be just a discrete approach, a one-on-one talk. If we use the discrete approach, we tend to come up with low prices. However, the confidentiality is actually maintained. On the other side is the full public auction. This probably comes with a highest price. However, everybody knows about that transaction. So if this transaction fails, usually your share price declines, because the people out there assume there's a problem with your company, and then they probably sell the share. On the other side, in the discrete approach, nobody will know. The one party can just walk away. So there's a balance between, on the one side, increasing the price, however, decreasing the confidentiality, vice versa. In the middle, you find the simultaneous bilateral negotiations. So actually, we have a couple of interesting purchases. And on the side here, on the right side, controlled competitive auction, we have a sort of competitive bidding environment, including, let's say, 10 or more potential buyers. So it's always the question, what is the purpose of the transaction? Do you want to maximize the money in? Do you want to increase the deal probability? What is your aim? Question number 8, why mergers and acquisitions? Well, we have different motives. If we are the acquirer, we want to enter into new markets. We want to overcome market entry barriers. We want to extend our geographic focus. We want to round up our product line, diversify our product portfolio. We want to get access to new technology, or work on the supply side or on the customer side. We would like to work on the production, marketing, sales, distribution side. And yeah, especially we would like to reduce cost by actually applying economies of scales. On the other side, if we analyze M&A from a seller's perspective, well, the seller wants to ensure long-term corporate success. If, for example, the seller has a succession problem, and then they might sell the company or sell the company partially, let's say 50% of the company, and maintain the corporate succession. You might want to focus on core competencies. You carve out some parts of your entity and sell that. Or you want to invest into existing or new business segments. You want to transfer sites. On the other side, you might want to improve the financial structures by a capital increase. You want to increase your cash position that is needed for further M&A activities. You want to realize corporate value through the sale proceeds. You want to redistribute shareholder wealth from corporate to private assets. You want to put the money into your own pockets, basically. And you want to search for an active shareholder who is interested in actually managing the company. So these are all motives for M&A. Why are we actually carrying out an M&A? Question number 9, why do we go for initial public offering? Let's start with the benefits and the opportunities. There might be an improved financial condition. Usually, the IPO comes with a capital increase, and by having a capital increase, well, more money actually will be inserted into the company, and our book value also increases. We increase the shareholder value by doing so and have fungibility of shares. If we are not IPO'd, well, it's hard to actually change the shareholder structure. Here, due to being IPO'd, it's quite easy. And this enables our diversification of the shareholder portfolios. We have more capital to stay in growth. So if we have a growth perspective, like we did here in our IPO case, look, there's the growth perspective. We want to get more money in, more financing, more equity-based financing if we have more equity, actually, we can also get more debt. And so we get really an opportunity to finance sustainable growth. We have improved opportunities for future financing, as mentioned, from equity to debt financing. We might actually add some mezzanine financing, depending on the specific case. It might be a path to M&A. From IPO, we actually can use our share as an acquisition currency, because we learned here that form of payment can not only be cash, but also shares. And once you are listed, you can actually rather easily buy companies. If we, for example, think about companies like Facebook buying WhatsApp, Facebook buying Instagram, and so on and so on. Had Facebook not been listed, it would have not been so easy to actually carry out the process. Number 8, employee participation. Well, we can give our employees a nice bonus, and not just in form of cash, but also in form of shares. We can enhance the corporate image and increase our reputation. Just more people know you when you are listed compared to if you're not listed. And the reassurance for customers and suppliers can be maintained. Let's have a look on the drawbacks. Well, on the one side, we're losing control, because on the one side, we're actually making a capital increase, but actually we are basically selling part of the company. And this actually is then now free float, or we have major other investors in the company. But basically, we are not owing the company by 100% anymore, or we might not be a major shareholder in the company at all. No? So basically, we are sharing success. We are sharing future success. We are losing privacy. So if you are listed, you need to publish the quarterly reports. If your list is in a big index, you need to maintain an investor relation department. It costs you a lot. You might not be able to use your national GAAP, but go for international GAAP, and so on and so on. Your privacy decreases, and this comes with constraints on managerial flexibility. You are less flexible because now the capital markets is supervising you. Corporate governance plays a much more important role than the bankers are there. No? The brokers issue broker reports where your action is analyzed in further detail. As mentioned, reporting is more difficult, more complex, and costs more money if you need to go from national to international reporting. You have initial and ongoing expenses. Like initial, maybe you change the structure from limited to PLC. Ongoing expenses, like you have to pay investor relations all the time. No? And finally, you have to deal with shareholders' expectations. Why going private? Reasons for going private. You are very much dissatisfied with a couple of issues. With a refinancing in the capital markets, your rating might have dropped. Your cost of debt increased. The shareholders' expectation towards the return on equity actually is just way too high. Your weighted average cost increases. If your weighted average cost is high, if your WACC is high, your DCF is low. The higher the interest rate, the lower the net present value. So the brokers write very bad stuff about you. No? Your analyst coverage is not really highly appreciated from your side. There's a valuation trap. You might be an automotive supplier in 2000 or actually in 2020, and that just is not highly appreciated in these times. No? In 2000, it was all about internet companies. In 2020, you don't have a platform, you have a valuation reduction. And this is called the valuation trap. Then it might be smarter actually to delist the company and wait for better times. Better times means when your sector is appreciated much more by the investors out there, and then maybe you come up with an IPO again. Your share price decreased, therefore your acquisition currency is too expensive. M&A becomes more complex. You might have a very bad or rather not so good corporate image. And by delisting, you are not so much in the press anymore, and you can cool down that bad corporate image. And finally, the so-called platform strategy. Platform strategy can be realized by a private equity company, for example, when Cerberus bought Chrysler, and then the captive was put together with GMAC, the captive of General Motors, and then they were focusing on Visteon, the automotive supplier, realizing a so-called vertical strategy. And this platform strategy, if you as a private equity can actually buy different entities by delisting them, put them all together, and then list that new entity, well, this can come with a big booster in terms of your return. What are benefits of going private? Well, cost reduction. You can reduce your costs, like the cost we mentioned here, like here from reporting, etc. You can optimize your cost of capital. You can take out and replace basically your expensive equity with cheap debt. Then because due to the fact the cost of equity is always higher than the cost of debt, by changing the debt equity structure, you can decrease the WACC and therefore increase shareholder value. You can have the management participating in the future success. You can come up with a more long-term orientation. Here in the IPO, we actually had reporting requirements, for example, quarterly report. Here, we just publish once a year, for example. The strategic planning is much easier, and you can stick to confidential information. There is no pressure, no need to publish all share price influencing information. You deal with less corporate governance issues, and actually your exposure towards lawsuits for security fraud is much lower. And finally, ladies and gentlemen, the cost of staying public increases due to the fact that the complexity of the legal framework currently is rather increasing and not decreasing. Ladies and gentlemen, if you want to analyze and scrutinize the issues mentioned here in further detail, and you want to read more about the answers to the 10 questions we analyzed, then feel free to read the respective pages regarding the specific questions. Ladies and gentlemen, I hope you liked the little video on mergers and acquisitions, initial public offering, and private equity. And I'll see you later. Bye-bye.